Every time you swipe your card, take out a loan, or check your savings account, there's an invisible hand shaping your financial life. It's not your bank, your boss, or even the government, it's the Federal Reserve. Most people know the Fed as the place that sets interest rates or prints money, but the real story is far more powerful and far more personal. The Federal Reserve doesn't just influence Wall Street. It quietly controls the value of your dollars, the cost of your mortgage, and the fate of your financial future. Let's start with the basics. The Federal Reserve, or the Fed, is America's central bank. Its job is to keep the economy stable, prices steady, and unemployment low. But how does it do that? The answer is a mix of science, art, and a little bit of magic. The Fed's main tool is the federal funds rate, the interest rate at which banks lend money to each other overnight. When the Fed raises this rate, borrowing becomes more expensive, spending slows down, and inflation cools off. When it lowers the rate, borrowing gets cheaper, spending picks up, and the economy heats up. But the Fed's influence goes much deeper. When it wants to stimulate the economy, it doesn't just cut rates. It can also buy government bonds in massive quantities, a process called quantitative easing. This floods the financial system with money, lowers long-term interest rates, and pushes investors to take more risks. The result? Stock prices rise, home values climb, and borrowing becomes easier for everyone. But there's a catch. Too much easy money can lead to bubbles, inflation, and instability. Contrast this with the Fed's role during a crisis. In 2008, when the financial system was on the brink of collapse, the Fed slashed rates to zero, bought trillions in bonds, and even bailed out major banks. In 2020, when the pandemic hit, the Fed acted even faster, propping up markets and keeping credit flowing. These moves prevented a total meltdown, but they also sparked debates about fairness, risk, and the growing power of the central bank. So, how does all this affect you? The Fed's decisions ripple through every corner of the economy. When rates are low, your mortgage, car loan, and credit card interest all drop. It's easier to buy a home, start a business, or refinance debt. But savers get squeezed, bank accounts and CDs pay less, and retirees struggle to earn income from their nest eggs. When the Fed raises rates, the opposite happens. Borrowing gets tougher, but savers finally see some reward. The Fed also controls inflation, the silent thief that erodes your purchasing power. If the Fed prints too much money or keeps rates too low for too long, prices rise faster than wages. Groceries, gas, and rent all get more expensive, and your dollars don't go as far. If the Fed acts too late, inflation can spiral out of control, as it did in the 1970s. If it acts too soon, it can choke off growth and trigger a recession. But the Fed's power isn't just economic, it's psychological. Every word from the Fed chair, every hint about future policy, can move markets and shape expectations. Investors hang on every press conference, looking for clues about what comes next. The Fed's credibility is its most important asset. If people believe the Fed will keep inflation in check and support the economy, they'll keep spending, investing, and taking risks. If that trust is lost, panic can spread in an instant. Contrast this with central banks in other countries. The Fed's decisions don't just affect America, they ripple across the globe. When the Fed raises rates, money flows into the US, the dollar strengthens, and emerging markets feel the pain. When the Fed eases, global markets rally. The world's financial system is built on the foundation of the US dollar, and the Fed is the architect. But with great power comes great responsibility. Critics argue that the Fed has become too powerful, distorting markets and widening inequality. When the Fed pumps up asset prices, the rich get richer, while ordinary savers struggle to keep up. Some say the Fed's actions have fueled bubbles in stocks, real estate, and even cryptocurrencies. Others warn that the Fed's balance sheet, now in the trillions, could become a ticking time bomb. So, what can you do? First, pay attention. The Fed's decisions may seem distant, but they shape your financial reality. Watch for changes in interest rates, inflation, and Fed policy. Understand how these moves affect your loans, your savings, and your investments. Second, stay flexible. In a world shaped by central banks, the rules can change fast. Diversify your assets, keep some cash on hand, and be ready to adapt. Finally, remember that the Fed is not infallible. It's run by people, not robots. They make mistakes, face political pressure, and sometimes get it wrong. But understanding how the Fed works and how it really controls your money gives you an edge in a world where knowledge is power. If you found this story eye-opening or learned something new, don't forget to like this video. Share it with someone who wants to understand the real forces behind their money, and subscribe to the channel for more insights into the world of finance and history. Your support helps us bring you the stories and strategies that can make a real difference in your financial journey. Hit the bell icon so you never miss an update, and let us know in the comments how the Fed's decisions have affected your life. Thanks for watching, and remember, in the world of money, the real power is knowing who's pulling the strings.